Hello, hi guys. This is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the today's class, we will be revising bank audit. This chapter it would be mostly practical in nature. Without wasting any further time, let us start the revision. Now, while conducting audit of bank, auditor he needs to take certain special considerations into effect because the banking business it is different when compared to other businesses. If you see, the nature of risk that is associated with the banking business is very high because banks main business is to grant loans, and the probability that the person who has taken loans not repaying them is very high. This makes banking business very much riskier. And also the scale of operations of banking business, generally banks they will operate in the form of branches across India, across the country. The bank will be having branches. So the scale of operations of a bank is very huge. Because of this scale of operation, auditor while conducting the audit he needs to take into account certain special considerations. This is a second reason that will necessitize the auditor to take into account certain special considerations while conducting the audit of banks. Next, extensive dependence on information technology. If you see, nowadays the banking business it is completely dependent on the information technology, starting from withdrawing amount in the ATM till making transfers by utilizing net banking. In each and every aspect of banking business, information technology is involved. Whenever information technology is involved, the chance of IT attacks is very high. Even this aspect of high dependence on information technology also requires the auditor to take into account certain special considerations while conducting the audit of banks. Next, statutory and regulatory requirements. If you see, there are various laws, numerous laws that are applicable on a banking business. This many laws and regulations makes banking business even more complicated. What are various laws that are applicable for banking business? We'll be seeing that next. And also continuing development of new products and services. These banks they will always be developing newer products. Okay, if you see banking business, their main business is to accept deposits and lend loans. Apart from these, they have entered into credit card. They are also helping insurance companies to sell insurance policies, and they are also entered into selling mutual funds. Okay, and they are also entered into managing portfolio of clients. Like this, they keep on adding new services uh, in the banking business. These new products and services also makes banking business even more complicated, and auditor need to take into account certain special considerations because of all these aspects that are involved in case of a bank. Now, what are various laws and regulations that are applicable to a bank? If you see, firstly, Banking Regulation Act. This is the main law that is applicable to banking business. Okay, entire banking business is regulated by this Banking Regulation Act. Next, you have RBI Act, Reserve Bank of India, which is established as per RBI Act, will regulate these banks, will regulate banking business in India. And Companies Act, some provisions of Companies Act are also applicable to banks. And Regional Rural Banks Act, basically some banks which are established in rural areas, will be calling them as regional rural banks. For them there is a separate act, Regional Rural Bank Act. And Information Technology Act, obviously since banks they will be using extensive information technology, IT Act is applicable to them. Next, Prevention of Money Laundering Act. If anybody wanted to convert black money into white money, that conversion process takes place through banking channels only. So this Prevention of Money Laundering Act is applicable on the banks. Okay, banks they need to comply with the requirements of Prevention of Money Laundering Act in order to avoid the clients from converting black money to white money. SARFAESI Act, Securitization and Asset Reconstruction Act, even this is also applicable to banks. Payment and Settlement System Act, if you take for example the UPI and issuing of checks, all these they will be covered under Payments and Settlement System Act. And Cooperative Societies Act, some banks, they they are incorporated as cooperative societies. Since some banks are incorporated or in the form of a cooperative society, this Cooperative Society Act will be applicable for those banks which are operating in the form of a cooperative society. And obviously if the bank is a listed company, then SEBI regulations will automatically get applicable to that bank because it is a listed company. Next, financial statements. Basically companies, they need to prepare financial statements as per the format that is provided in Schedule 3 of Companies Act. But for banks there is a separate format that has been provided by Schedule 3 of Banking Regulation Act. Now in this Banking Regulation Act, in Schedule 3 there is Form A. Form A deals with format of balance sheet, and Form B, it deals with format of profit and loss statement. And also banking companies, in preparing their financial statements, they need to comply with requirements of Section 133, that is Indian Accounting Standards. Okay, they need to comply with Indian Accounting Standards. The same is discussed in section number 133 as well. Next, appointment of auditor. Here you just need to make some change. Basically for all the nationalized banks, auditor will be appointed by board of directors. And in case of other banks other than nationalized banks, auditor will be appointed by members in the annual general meeting. In both the cases you will be requiring RBI approval. Here you can just strike off this SBI point. Even State Bank of India is also a nationalized bank, so the auditor of State Bank of India will also be appointed by board of directors only after taking permission of RBI. Okay. However, there is a empanelment. All the chartered accountants, they need to empanel with RBI. From that list of empanelment, the board of directors of the bank, they will select the auditors for the bank. Okay. And in case of regional rural banks, the concerned bank with the approval of central government will appoint auditors. So this is with respect to appointment of auditors. And in case of banks, there is concept of statutory central auditor and statutory branch auditor. Since the head office, okay, the bank's head office, it will be audited by statutory central auditor. Okay, bank as a whole will be audited by statutory central auditor. And there will be various branches. These branches, they will be audited by statutory branch auditor. Okay, and bank as a whole will be audited by statutory central auditor. Hope that is clear. Now both the auditors, for the branch as well as for statutory central auditor, the appointment will be made through board of directors. In case of nationalized bank, and in case of other than nationalized bank, normal, generally how it takes place in the normal companies, like the shareholders in the annual general meeting, they'll appoint auditors. Not the same process in case of other than nationalized banks. What happened to this? Just a second. Yeah. Next, stages of bank audit. Now, just like in case of any other audit, there are certain stages that are involved in a bank audit. Firstly, you will be having initialization stage. In the initialization stage, you will discuss terms and conditions of the audit. You will communicate with the previous auditor. You will see whether auditor is having any indebtedness with the bank, and whether auditor is conducting any internal works with related to the bank, and aspects with respect to acceptance of the bank audit. All these aspects will be covered in case of initial consideration stage of a bank audit. Once this assignment has been accepted, the auditor, he will understand the bank. He will understand the information technology that is being used by the bank, and he will also understand the banking business, the products that the bank is dealing with, and the internal controls that the bank has implemented, whether the internal controls are working properly or not, in which areas the internal controls are present. All these internal controls auditor will understand. He will also understand the accounting process that the bank is using, okay, the accounting system, the software, and the process that the bank is using with respect to accounting. And risk management process, what is the risk management process that the bank is following in order to identify and mitigate the risk that the bank possesses. So all these aspects auditor he will understand, okay, he will understand banking business, the information technology that it is using, accounting process that the bank is following, the internal controls the bank has implemented, and finally the risk management process that is present in the bank. All this he will understand. After that, obviously he will perform risk assessment, just like by using essay 315. In essay 315 we will be studying identifying and assessing the risk of material misstatement through understanding the entity and its environment. So here auditor he will identify and assess the risk of material misstatement. Why he is identifying and assessing risk of material misstatement? Obviously in order to decide his audit procedures, he is understand identifying and assessing the risk of material misstatement. Risk of fraud including money laundering, okay, he will assess whether there is any risk of fraud in the bank, including whether there is any chances of money laundering that has taken place in the bank. He will assess this risk and assess any other specific risk apart from fraud. Is there any other specific risk that the bank is posing? Auditor will assess this. And risk associated with outsourcing activities, all these risks auditor will identify and assess. And that is the third phase, that is risk assessment phase. And next, execution phase. In this execution phase, engagement team discussion will take place, okay, based on the identified risk of material misstatement. Engagement team, they will discuss among themselves to determine the audit procedures and respond to assessed risks of material misstatement. After discussing among themselves, they would have come up with the various audit procedures that they wanted to perform. So those audit procedures are response to the risks that the auditor has identified in the third phase, okay. And determine audit materiality, consider going concern assumption. All these you will do in execution stage. Finally, in the reporting phase, you will give your audit report, including long form audit report and any other certifications that you have to provide. All those you will provide to the bank, okay. These are various stages that are involved in a bank audit. Next, certain general internal controls that the bank should maintain. Firstly, they should shift the position of the staff without giving any prior notice to them. So this way the frauds that have been committed by the employees can be identified easily. So you need to shift their positions without giving them any prior notice, and you should implement maker checker concept, okay. The workflow should be designed in such a way that work that has been performed by one person will automatically be checked by another person. That is maker checker concept. And at the end of each day, the arithmetical accuracy of books of accounts must be proved. If you see the bank, it will close for customers by 4 o'clock, but even after 4 o'clock the bank employees, they will be working, okay. They will be tallying the accounts, or they will be tallying the transactions that have taken place during the day. So each day the arithmetical accuracy of the books has to be proved, and all the bank forms, they must be kept in a proper you know authority of a officer, okay. All bank forms should be in possession of one officer, and the access to mail should not be given to all the officers. Only the authorized officer should be allowed to open the mail. And clear differentiation of financial powers, okay. In order to grant loan of 10 lakh rupees, the authority can be with assistant manager, But if the amount of loan is exceeding 10 lakhs rupees, you need to take approval of manager. If amount of loan exceeds 1 crore rupees, you need to take approval of head office. Like this, a clear bifurcation of financial powers must be there. And periodic surprise in inspection by head office and branch office. Okay, you need to periodically inspect head office as well as branch offices of the bank. So these are certain general controls that a bank must maintain. With respect to cash, what controls the bank should have with respect to cash? First of all, the cash has to be kept in the joint custody of at least two officers. Okay, two officers must be held responsible for safeguarding the cash. It should be in the joint custody of two officers, and daily test check and occasionally full count by other officers. Apart from these two officers, other officers should be given responsibility to test check whether the cash, the physical cash is matching as per books of accounts or not. No access to cashier to customer ledger account and day book. The person who is having access to cash, that is the cashier, he should not be given access to customer's account. Because if he has been given access to customer account, there is possibility that he might take the cash and he might pass a entry that customer has withdrawn. So the cashier, he should not be having access to customer's account. Make payment only after authorization and entry in the customer account. You need to make payment to the customer in case of withdrawal only after the withdrawal has been authorized and the entry has been made in the customer's account. And compare receipt or payment scrolls with cash column of the day book. At the time of depositing amount into the bank, customer, he will write a deposit slip. In the same way, at the time of withdrawal also, withdrawal slip will be there. So these slips, they have to be matched with the entries in the day book. And high value cash transactions to be verified by higher officer or manager. Okay, any high value transactions, each bank, they will be having their own limit. Okay, some banks, they might say that if cash withdrawal is exceeding 10 lakh rupees, then it might be high value transaction, and it requires authorization of manager, and it must be verified by the manager. Like this, each bank might have their own limit. And remit excess cash to currency chest. Basically, banks, the bank branches, they will not be having power to retain cash exceeding certain limits. Okay, based on the size of the branch, each branch will be having its own cash retention capacity. If it is having, at the end of the day, if amount of cash is exceeding its retention limit, then that cash has to be sent to treasury office. Okay, or the current currency chest. Next, check clearing. Now, with respect to check clearing, what should be certain internal controls that must be kept? Now, let's say there is HDFC Bank. HDFC Bank, SBI Bank. Now, Mr. A is having account in HDFC Bank. He has given HDFC Bank check to Mr. B. Mr. B is having account in SBI Bank. So he went to SBI Bank and he has deposited that check with SBI Bank. Now, this SBI Bank, what it will do is, it will send this check, not the physical check. The scanned copy of the check will be sent to HDFC Bank to confirm whether Mr. A is having that respective amount in his account or not. Okay, once got confirmation from HDFC Bank, SBI Bank, it will transfer the amount to the account of Mr. B. Now, here in this situation, whenever such check is received by HDFC Bank, if the amount of check is exceeding certain limit, basically it is 5 lakhs. If any check has come to bank for clearing exceeding 5 lakh rupees, it once needs to call the customer and confirm whether the check has actually been issued by the customer himself or not. the, this is one of the internal control that must be present in the bank. And also the signature that is present on the check has to be verified by the bank with the help of the signature book. While opening the account, the bank would have taken the specimen signature copy of the customer. So the signature that is present on the check has to be verified with the specimen signature, whether both are matching or not. This is also one of the internal control that must be present. Next, if the check that has been given by Mr. A has bounced, that means the Mr. A is not having the specified amount in his bank, then SBI bank, it should inform to its customer, that is Mr. B, and ask Mr. B to come and collect this check which has bounced. Even this is also one of the internal control. Okay, see, with respect to check clearing, call or email the customer if the check received for 5 lakh and above. Auditor shall test check whether those calls and mails have been made or not by the bank. The alternative test check. Check whether signature of drawer of check is being verified by the bank staff with respect to the specimen signature. Unpaid checks to be sent back to the customer. If any check is unpaid, that is, if any check has bounced, it has to be sent back to the customer. Next, bills for collection. What is this concept of bills for collection? Now, Mr. A, he has sold goods on credit basis, and with respect to such credit sales, he is having certain bills receivable, and the customer, the debtor, is present, let's say, in Maharashtra, but Mr. A, let's say, he is present in Andhra Pradesh. Now what Mr. A, he will do is, he will ask his banker, SBI bank, let's say, in Andhra Pradesh, to collect this bills receivable on behalf of Mr. A. So SBI bank, it will also be having its branch in Maharashtra, right? Through its branch, it will collect the amount from the respective customer, and it will give the amount to the bank that is present in the branch that is present in Andhra Pradesh, and from there amount will be given to Mr. A. Now, in this process, since the bank has provided certain service of bills collection to Mr. A, certain commission will be charged by bank. This is how bills receivable will work. Now, with respect to bills receivable, what internal control should be there? All relevant documents to be received and entered in the register. Now, bank, it is collecting the bills on behalf of customer. Now, in order to prove that customer has authorized the bank to collect the bills on his behalf, it will execute certain documentation. It will also collect the original invoices. So all this documentation must be properly made by the bank, and it should be kept in its file. Okay, and credit the customer's account only after bills have been collected. You should not credit the customer's account until and unless you have received the amount from the respective third party. Only after amount has been received, you should credit the customer's account, and ensure that there is no dual entry for bills sent from one branch to another branch in amalgamated balance sheet. Now, if you see here in this case, the SBI branch of Andhra Pradesh has sent bills to Maharashtra branch of SBI. Now, the Maharashtra branch, in its books of accounts, it will make entry as bills receivable for collection. And also the SBI bank of Andhra Pradesh, while it has when it has received the bills receivable from Mr. A, then also it would have made entry in its books of accounts as bills receivable for collection. So here, if you see at the individual branch level, it is okay, but when these are amalgamated, there will be dual entry. So in case of amalgamated, okay, in case of the accounts at the entire bank level, the auditor need to take care that such dual entries have been removed. Only one entry should be there for each bills for collection. Okay. Next, bills purchased. Now in case of bills purchased, bank, it will not just collect the bills, it will not just provide service of bills collection for the customer, but it will, before collecting the bills itself, it will give the amount to the customer. But in case of this bills purchase, the amount of commission or the amount of discount that the bank charges, it will be somewhat higher, right? So in case of bills purchased, what are the internal controls that must be checked? Officer has to verify that the title documents are assigned to bank. Here the bank, it is not taking these bills receivable just for collection, it is purchasing the bills receivable. So here the title of that bills receivable must be transferred, the ownership has to be properly transferred to the bank name. So whether ownership has been transferred or not, the auditor needs to check. Sufficient margin or discount must be kept. Now here in this bills purchase process, there is some risk involved to the bank. It is purchasing the bills, let's say the bill is worth 1 lakh rupees, it is purchasing the bill worth 1 lakh rupees, and it needs to collect this 1 lakh rupees from some third party, right? From the debtor, it needs to collect this 1 lakh rupees. What if debtor doesn't pay the amount, or what if he delays in payment of the amount? Bank will lose, because it has already given the amount to the person who has sold the bill. So to avoid or to cover these situations, it needs to maintain a proper margin. The bill worth 1 lakh rupees, the bank might purchase for only 95,000. Okay, so 5,000 rupees is the income for the bank. So like this, sufficient margin must be kept by the bank. If bank fails to collect on due date, take steps to recover from the drawer. Okay, if the bank fails to collect the bill, it needs to take necessary action against the drawer of the bill, that is the person who has sold the bill to the bank. Report irregular outstanding accounts to head office. If at all there are any irregular outstanding accounts, you need to report them to the head office. And for bills outstanding at close of the year, properly apportion the discount between 2 years. Yes, as on 31st March, the bill is still outstanding, but it is not yet due for collection. In those situations, the discount that the bank has earned on that bill receivable must be properly apportioned to both the years. Whether such apportionment has been made properly or not, auditor needs to see. Just a second. Loans and advances. With respect to loans and advances, what are the internal controls that must be present? See, first of all, while granting the loan, officers, the bank officers, they must properly perform credit worthiness. They must check the credit worthiness of the borrower. Only after checking the credit worthiness of the borrower, you can sanction the loan. How you can check credit worthiness? You can check the CIBIL score, you can verify the past loans that the person has taken, and whether he is proper in repayment of those loans. You can verify the assets that are in the name of the person. With the help of all this, you will verify the credit worthiness of the borrower and execute all necessary documents. While granting the loan, you need to execute all the documents. If the person is offering any security, the security must be properly registered in the name of the bank. And if at all any insurance is necessary, you need to make proper insurance. So all the documentation with respect to granting loan, you need to properly execute them. And sufficient margin against the security must be kept. Let's say the borrower is offering a piece of land as security, and the value of the land is, let's say, some 1 crore rupees. For 1 crore rupees value of land, you cannot give a entire 1 crore as loan, you will have to keep certain margin. Let's say for 1 crore worth of land, you can give loan of some 75 lakhs by keeping 25% as margin. So based on internal policies of the bank, they need to maintain sufficient margin for the security, and security should be in the joint custody of two officers. Okay, register securities in bank's name. Yes, the security, it should be registered in the bank's name, and all accounts to be within the drawing power and sanction limit. See, what is this sanctioned limit and drawing power? Both are different. Basically, this will be mostly applicable in case of working capital loan. Okay, while discussing that working capital loan, we'll discuss the concept of drawing power and sanction limit. Okay, now you just understand that auditor, he needs to check that all the loan accounts, they should be within the drawing power limit and the sanction limit. However, on ad hoc basis, certain 20% can be temporarily given. Okay, 20% exceeding the sanction limit can be given for a maximum of 90 days. Okay, in case of any urgent requirement to the borrower, an additional amount in excess of the sanction limit up to 20% can be given for a maximum of 90 days on ad hoc basis. Okay, on need basis. And irregular accounts has to be brought to the notice of head officer. If there is any delay in repayment of the loan, then the same has to be properly intimated to the head officer, or any other irregularities in the account, it needs to be reported to the head officer. And review operation in each advance at least once in a year. Okay, once in a year, you need to, the branch manager, he need to review, manager or any other proper officer, he need to review the transactions that has taken place in the loan account. Okay, so based on that review, they can decide, the branch staff will decide whether to reduce the drawing power, whether to reduce the sanction limit, or whether they can increase. So based on the review, they will take the decision. Next, internal controls with respect to credit card operations. This is one of the important question, you can say. First of all, while granting credit card to any customer, proper screening of the application must be done. Whether you can grant the credit card to him, and how much limit you can grant to him, all this, it needs to be properly screened while taking the application. And there should be proper control over storage and issuance of the cards. The unused cards, the cards which have not yet been issued to customer, they must be kept in the proper custody of the authorized officer. Okay, and merchant, before accepting payment from the customer through the credit card, the machine that is available with the merchant, it should be having capacity to confirm whether this particular customer is having the credit limit or not. Okay, with the bank, the merchant must confirm whether the customer is having the respective credit limit that is necessary for the transaction or not. Only after such confirmation has been taken, the transaction must be completed. Obviously, the POS mission that will be available with the merchant, it will communicate with the bank servers to check whether the card is having the respective limit or not. And prompt reporting by merchants of all settlements that have been accepted through cards. All the payments that the merchant has accepted by using the credit card, it needs to be reported to the bank. Okay, at the end of each day, total amount that has been collected through credit cards, the merchants, they will report to the bank. And the merchants, they will be reimbursed by the bank only after verification that the merchant has actually accepted the credit card, the merchant has actually sold his goods or services after accepting the credit card. Only after this confirmation, bank will reimburse the merchant. And once the merchant has been reimbursed, the respective debit entry must be made to the customer. The customer account has to be charged, immediately charged to the customer account after you have reimbursed the merchant. And send regular statements to the customer. Obviously, at the end of each month, The list of all the transactions that has been spent by the customer by using a credit card, it will be sent to the customer, and review accounts periodically to revise the limits. Generally, once in every year, the customers accounts, they will be reviewed in order to check whether any additional credit limit can be granted to the customer, and monitor and follow up customer payments. If customer is not properly paying the credit card due amount, you need to follow up the customer and recover the amount due from the customer. Okay, next, coming to CRR and SLR: cash reserve ratio, statutory liquidity ratio. What are these cash reserve ratio and statutory liquidity ratio? Generally, banks, they will accept deposit from the customer and give loans to various borrowers. If bank gives entire amount of deposits that it has accepted as loan to the borrowers, then if suddenly the borrowers comes to bank for withdrawal of amount, the bank will face liquidity crunch. In order to avoid this type of situation, CRR and SLR have been introduced. CRR refers to cash reserve ratio. 4.5% of the total deposits must be kept in the form of cash reserve ratio with RBI. Okay, this CRR has to be maintained with RBI. Each and every bank will maintain with with RBI. Now, in this CRR, cash and bank deposits, these two will be present. See, certain percentage of deposits is maintained with RBI in the form of deposit or in cash. Sorry. So CRR will be maintained in the form of cash or in the form of certain deposits for a fixed period of time with RBI. Okay, each and every bank must maintain this CRR, and percentage of CRR is 4.5% of total deposits. Coming to SLR, the requirement of SLR is also similar to that of CRR only, but SLR, it will not be maintained with RBI. The bank itself internally, it will maintain SLR. Okay, the SLR is statutory liquidity ratio. It is 18%. 18% of what? 18% of net demand and time liabilities. What will be included in this demand and time liabilities, we'll discuss now. In which form bank can maintain this statutory liquidity ratio? Bank can maintain SLR in the form of gold, okay, as an investment in gold, or in the form of cash itself, or in the form of government approved securities. In any of these three forms, bank can maintain statutory liquidity ratio of 18% with itself. Okay, this SLR, it need not be deposited with RBI. Only CRR has to be deposited with RBI. Hope that is clear. And here I have told you now, SLR of 18%, it will be calculated on net demand and time liabilities. How this calculation will be made? Generally, the net demand and time liabilities as on last Friday of second fortnight. Okay, net and demand liabilities that are present as on this day will be taken. Net demand and time liabilities. First of all, what is this last Friday of second fortnight? Let us understand this with an example. First of all, what is the today's date? If you see here, today's date is 19th. Now let's say you wanted to calculate SLR requirement on 19th. This SLR requirement of 18%, it needs to be maintained at the end of each and every day. Okay, SLR needs to be calculated each and every day, at the end of each and every day. For calculating this SLR, we will be requiring two things. One is net demand and time liabilities, another one is percentage. Percentage is 18%, that is fixed. However, that percentage bank, it will be keep on changing. Okay, you can find it from the RBS website, but as of now that percentage is 18%, and you need to determine net demand and time liabilities of the bank. So for determining this net demand and time liabilities, you will take the net demand and time liabilities that are present as on last Friday, sorry, yeah, last Friday of second fortnight. Now if you see, on this day, on 19th, which will become last Friday of second fortnight. Basically fortnight means 15 days, and you will calculate this fortnight from Saturday to Friday. Now if you see here, 19th, it is Monday, and when is Friday? 16th. 16th is Friday. So from 16th onwards, you will go 15 days back to Saturday. So the first 7 days, it's on 10th, and the second 7 days, it's on 3rd. So from 3rd, because 3rd is Saturday, so from 3rd to 16th is one fortnight. Okay, here the requirement is you need to calculate net demand and time liabilities on last Friday of second fortnight. Here 3rd to 16th is first fortnight, because we are standing in 19th. For 19th, the first fortnight is 3rd to 16th. Okay, in banking terminologies, from Saturday to Friday, 15 days we need to consider as fortnight for this requirement. Okay, so from 3rd to 16th is first fortnight as on 19th. Second fortnight becomes, however, the second fortnight, it will be before 3rd. So we need to find out the net demand and time liabilities as on last Friday of second fortnight. So last Friday of second fortnight becomes second. Okay, if you see, Friday is the second, till 3rd our first fortnight completes, and till second the second fortnight completes. So the last Friday of second fortnight becomes second Friday. So on second Friday, you need to calculate net demand and time liabilities. How much net demand and time liabilities is available with bank, you need to calculate that. On that, you need to multiply by 18%, and that SLR you need to maintain on 19th. Even on 18th also you need to maintain that only. Even on 20, 21, 22, 23 also you need to maintain that only. But on 24th it will again change, because the fortnight calculation, it will again change. For 24th, you need to again calculate the net demand and time liabilities that are present as on last Friday of second fortnight. So for this, the first fortnight, let's say for example, if we are on 24th, then the first fortnight becomes from 23rd to 17th to 10th. So from 23rd to 10th becomes the first fortnight, and the second fortnight will end on 9th, that is on Friday. So the last Friday of second fortnight becomes 9th. So if you are calculating net demand and time, if you are calculating SLR requirement on 24th, then you need to take the net demand and time liabilities that are present as on 9th, but not that are present as on 2nd. Okay, but if you are calculating SLR on 23rd, then you need to take net demand and time liabilities that are present on 2nd. But if you are calculating SLR on 24th, then you need to take net demand and time liabilities that are present on 9th. Hope that is clear. So this way you will calculate net demand and time liabilities, because most of the students, they will be confused with respect to this. So I have explained it somewhat clearly. And there will be certain items that will be specifically included in net demand and time liabilities, and that will be specifically excluded in net demand and time liabilities. We'll check that. Audit approach regarding CRR and SLR. Understand RBI circular regarding the demand and time liabilities. Okay, RBI, it has issued a circular with respect to demand and time liabilities. In that circular, it has told what will be specifically included, what will be specifically excluded from these demand and time liabilities, that you need to see and examine demand and time liability position based on consolidation of branch trial balances. See, another important point, this CRR and SLR, they need to be maintained not at the branch level, but at the entire bank level this CRR and SLR has to be maintained. So the net demand and time liabilities you need to calculate at the bank level, not at the branch level. Okay, from the branches the trial balances they will be sent to the head office, and at the head office the net demand and time liabilities will be calculated, and SLR requirement will be complied at the head office level. Okay, at the entire bank level. Hope that is clear. So now what will be included in demand and time liabilities? What will be specifically included in demand and time liabilities? First of all, demand and time liabilities means, for a bank, what will be the liabilities? The amounts that have been deposited by customers with the bank are the liabilities. And these liabilities, they can be two types. One is demand liability, that is savings deposits, they become demand liability for the bank, and term deposits, that is the fixed deposits, they become the time liabilities for the bank. So these will be however included in the demand and time liabilities. Apart from these, there are certain specific items that RBI has asked to include them in demand and time liabilities. What are they? That we'll see now. Net credit balance in the branch adjustment account. Now there will be various transactions between the branches of the bank. Now if uh, any of the transaction is not yet reconciled, then that transaction it will be parked temporarily in branch adjustments account. Now, if at all at the entire bank level, if there is any credit balance available in the branch adjustment account, that credit balance needs to be considered as demand and time liabilities. Why this requirement has been kept? In order to encourage the banks to clear the pending entries, the suspense entries in the branch adjustment accounts. Okay, to keep the branch adjustment accounts clear, up to date every time, the RBI has introduced this requirement that if at all any credit balance is available in the branch adjustments account, that needs to be included in the net demand and time liabilities. What is the loss for bank if it includes it in net demand and time liabilities? If it includes in net demand and time liabilities, it needs to maintain more SLR. Okay, if it needs to maintain more SLR, then the fund will get blocked to the bank. Okay, what is the meaning of SLR? The amount that has been maintained as SLR, it should not be utilized by the bank for giving loans. Bank, it always wanted to give as much as amount as loan, because it will earn interest income. If the SLR requirement increases, then amount of funds that gets blocked will get increased. If it increases, then the bank will suffer loss of interest, right? So in order to avoid this, what banks will do? Banks will always try to uh, keep update this branch adjustment account. Hope that is clear. Next, borrowings from banks abroad. If the bank has taken any borrowings from foreign banks, even that has to be included in net demand and time liabilities. Next, interest accrued but not accounted in books of accounts. Okay, if at all any interest amount has accrued but it is not due, so you have not accounted them in the books of accounts, even then you need to include this in the demand and time liabilities for calculation purpose. Hope that is clear. Next, exclusions in demand and time liabilities. There are certain items that needs to be excluded. What are they? Paid up share capital, reserves, loan from RBI, loan from Exim Bank, loan from National Housing Board, loan from SIDBI, and loan from NABARD. If you have taken loans from any of these, you need not include them in the net demand and time liabilities. Next, amount of recoveries from doubt and bad debts. Okay, if you have recovered any of the amount from bad debts, you need not include it in the demand and time liabilities. Amount received in Indian rupees against the import bills held in sundry deposits pending receipt of final rates. See, generally, whenever, let's say for example, there is Mr. A has imported goods from USA. Now for this import, Mr. A has to pay in the form of dollars, but Mr. A, he will not be having dollars. So what he will do? He will deposit the amount in INR with, let's say, SBI Bank. Once he has deposited Indian rupees with SBI Bank, it will convert Indian rupees into foreign currency and it will make the payment to respective person in the USA. Now, till the time the final conversion rate is got by SBI, these funds, the Indian rupees which were deposited by Mr. A, they will be parked in a separate account. So now these funds which were received in Indian rupees, which are waiting for conversion rate to be received, they need not be included in demand and time liabilities. Hope that is clear. Because however, they will be paid once the conversion rate is received, they will be converted to US dollars and they will be paid to the respective person immediately. So you need not include them in net demand and time liabilities. Next, unadjusted balances in link branches for payment made by such branch, margins held and kept in sundry deposits for funded facilities. All these items you need to exclude in demand and time liabilities. Next, verification of certain assets. Now, banks, they will be having various assets. Of those assets, there are certain important assets like cash, investments, and there will be certain fixed assets. And the major asset of the bank is the advances that the bank has given. So, how to verify these assets? We'll discuss one by one. First of all, starting with cash. In case of cash, the simple verification procedure is you will physically verify the cash. You will check whether that physical cash is matching with books of accounts or not. And if the bank is having any ATM under its control, you will also verify the cash that is present in the ATM. This is a simple verification procedure with respect to cash. Next, balance that is available with RBI. Now, with respect to balance that is available with RBI, basically banks, they need to maintain CRR with the RBI. Along with CRR, banks, they will also be maintaining certain amounts with RBI. So with respect to these amounts, you will obtain balance confirmation from RBI, and you will check whether that amount present in the balance confirmation that has been issued by RBI is matching with the books of accounts of bank or not. And you will also review the reconciliation statement between the balance as per books of accounts and balance that is given as per, by RBI. Now, in this reconciliation, you will give specific consideration, special attention to the following transactions. Cash transactions remaining unresponded. Now, the bank in its books of accounts, it has made an entry that cash deposited with RBI, but in the balance confirmation that has been issued by RBI, that cash deposit transaction is not being reflected. So this becomes unresponded cash unresponded sorry unresponded cash transaction. So you will give specific attention to this type of transaction, why it has not been reflected in the RBI confirmation that has been sent, what is the reason behind it, you will verify that. Next, revenue items requiring adjustments. Revenue items means generally in this situation, revenue item will be for the amount that the bank is maintaining with RBI. RBI will grant certain interest. So this interest becomes revenue item, whether it has been properly granted or not. And RBI, it might also charge certain account charges, whether these account charges that have been debited by RBI are properly booked by the bank in its books of accounts or not. This you will see in the reconciliation. And other credit and debit entries remaining unresponded for a period of more than 15 days. If at all there are any other credit or debit entries which are unresponded for a period exceeding 15 days, then you will check why they are not reflecting in the books of accounts of bank, or why they are not reflecting in the balance confirmation that has been sent by the RBI. Because the period of 15 days, it is a huge period. Okay, in this period it should have been adjusted. So even after 15 days, why it is not being reflected, you'll check this. Next, balance with other bank. In the similar way, just like banks maintain balance with RBI, banks will also be having balances with other banks. There will be uh, interbank transactions, right? Between the banks, some transactions will take place. So with respect to them, there will be balances available with the other banks. So same procedures that you will perform with respect to balance available with RBI, you will perform the balance confirmation, verification of a reconciliation statement that you will perform. And no debit for charges, credit for interest is outstanding. Okay, interest has been properly given, and any charges have been properly charged. Nothing is outstanding. You need to verify that. And no check sent or received in clearing should be outstanding. Okay, it should not be outstanding for a more than unreasonable period of time. It should be cleared. And examine large transaction to ensure that there is no window dressing, basically in order to cover up any frauds that the employees have committed in the bank. To cover up them, they might pass some fictitious journal entries in the form of these interbank transactions. So auditor needs to check whether there is any such window dressing that has been done in order to cover up the frauds. And checks or bills outstanding as on date or credited subsequently, basically this it will get reflected in the reconciliation statement as on 31st March. If at all there are any checks outstanding or bills outstanding, they should be credited subsequently. Okay. Next, with respect to money at call and short notice, with respect to this, what audit, what points you will verify? First of all, there should be proper authorization from the responsible officer, because money at call and short notice means here there will not be any security that will be taken by the bank. The amount will be given as a loan just for a shorter period of time, like just for 1 week or 10 days or 15 days. For a shorter period of time, these loans will be given. For these types of loans, they will be just given based on certificate from the borrower. No security will be taken by the bank. Since no security is taken, the risk will be high. So there should be proper authorization for granting this type of money at call and short notices, and compliance with instructions of head office and controlling office for granting these money at call and short notice. Each bank, it will be having its own set of guidelines. You need to follow those guidelines. Verify with certificate of borrower. Auditor, he needs to verify whether the certificate from the borrower has been taken, and you should also verify the call loan receipts that are available with the bank, and examine subsequent repayments received, whether subsequently these call loans that have been taken by the borrower, whether they are repaid or not, that you need to see. Do not net off call loans given against the call loans taken. Generally, in most of the cases, these call loans, they will be taken by the banks itself. Let's say SBI bank, HDFC bank. Now a particular branch of SBI, it might be having some shortage of cash. So what this branch will do, it will go to its nearest HDFC branch, and it will ask for a call loan of some, let's say, 1 crore rupees. Within 7 days or 1 week, it will repay. On these terms, it will ask for call loan from HDFC. So HDFC will give a call loan of 1 crore rupees to SBI bank. Now this becomes call loan received by SBI. In the same way, SBI bank might have also given some call loans to other banks. Now in the balance sheet of SBI, you should not net off these both call loans received and call loans given. Okay, call loans received becomes liability, call loan given becomes asset. Hope that is clear. Next, verify accounting for interest. Interest for these call loans, it has to be properly charged. Next, audit procedure for investments. Now the amount that is available with the bank, it will invest these amounts in various securities, in various mutual funds. In the same way, bank will also maintain, or bank will also provide portfolio management services to its clients. That means on behalf of clients money, the bank will invest in various securities. This is known as portfolio management services. So in the bank itself will invest its own money, and bank will also invest on behalf of its customers. That is portfolio management services also bank will provide. Now with respect to this, first of all, in the bank, you need to review the investment policy of the bank. Each bank, it will be having its own investment policy. In investment policy there will be guidance with respect to in which type of securities the bank can invest. Okay, basically for securities there will be credit rating. Okay, for credit rating below certain limit that is prescribed in the investment policy, the bank should not invest. Like this, certain guidance will be there with respect to investment of the bank in the investment policy. So whether such investment policy is properly followed or not, the auditor need to review it. Next, separation of investment functions. Now in the investment function, in the investment department there will be various functions. Okay, one set of people, they will perform market research analysis regarding which type of investments has to be bought, and another set of people, they actually involve in purchasing the investments from the market. In open market activities they will sorry, they will involve, and another set of people, they will monitor the investments that have already been made. Like this, the investment function needs to be bifurcated among different set of people. Whether such a, you know, bifurcation of investment function is there or not, you need to check. Next, physically verify the scripts. Mostly these days the securities, they will be in dematerialized format, but in case if at all there are any physical investment scripts, auditor need to verify these physical investment certificates. And in case of dematerialized format, you need to obtain confirmation from the depositories. Basically depositories, you will be having NSDL and CDSL. From them you need to obtain confirmation. Okay, see, obtain confirmation from depositories and custodians. Custodian means on behalf of banks, some third party is holding the investment, we will be calling him as custodian. And examine proper classification into held to maturity, held for trading, available for sale. Basically the banks, the investments that the bank has made, they will be categorized into three categories. Based on the category in which it is, the investment, the accounting treatment of that particular investment will vary. So you need to check whether this categorization has been properly made into held for maturity, and held for trading, and available for sale. Okay, whether this categorization made properly or not. Next, examine valuation, accounting, and the income recognition has been done as per the respective accounting standards or not. Next, special purpose certificate related to investment. Now as I have already told you, the investments that the bank makes, they will be of two types. One, investment on behalf of its own funds. Okay, the bank's own funds the bank will invest. And another type of investment, the client's money, the bank will invest, that will call as portfolio management service. Now examine whether separate accounts maintained for investments which are made on their own account, PMS clients account. PMS means portfolio management service, and other constituent. Okay, the bank, it should maintain accounts separately for each of these categories. For investments that it has made on its own account, there should be separate accounts, and for investment that are made on account of clients, that is portfolio management service clients, separate accounts needs to be maintained. Hope that is clear. And get investment under PMS separately audited by external auditor. Okay, the investments that the bank has made in portfolio management services business, that investments need to be audited. Okay, the accounts with respect to that PMS related service needs to be audited by separate external auditor. Next, with respect to advances, what points you will verify? First of all, with respect to advances, the master data, it should be correct. Auditor needs to verify whether the master data that is fed into the system is correct or not. Okay, master data, what will be included in the master data? Name of the borrower, and the type of loan that he has taken, and the rate of interest for that loan, and the security that has been offered for that loan. All this basic information, core information with respect to the loan, will be present in master data. Whether this master data is correctly fed into the system or not, you need to check, because based on this master data only, let's say for example, in the loan agreement it has been written that the rate of interest will be some 9%, but in the master data the rate of interest has been mistakenly typed as 8% only. Now system will calculate rate of interest at 8% only, even though the actual rate of interest is 9%. So auditor need to review whether master data has been correctly uh, input into the system or not, correctly fed into the system or not. Next, all accounts of a customer are tagged to a single customer ID. Basically, in the bank, each customer will be having a unique customer ID, and under that customer ID, various accounts will be opened. Let's say, for example, there is one particular customer, customer one. Now, this particular customer, he wanted a savings account. So first of all, for him, a customer ID will be created, and under that customer ID, okay, just a second. Under that customer ID, a savings account will be open to him. Now in future, this person, he also wanted a current account. Now the current account will also be opened under the same customer ID, and in future he wanted certain loan, let's say housing loan. Now the housing loan, it will also be given under the same customer ID. Let's say he further wanted some working capital loan, it will also be given under the same customer ID. Okay, the products will vary. For products, the account numbers will vary, but the customer ID of the person who has taken those products will be same. Hope that is clear. This should be followed in the banks. Whether it is followed or not, you need to check. Examine problem accounts not yet slipped into NPA. Basically, we will be calling them as SMA accounts. We will be having SMA 0, SMA 1, SMA 2. SMA 0, SMA 1, SMA 2. So the loan account in which no interest or no principal has been received, or interest or principal is outstanding for a period of 0 to 30 days, those accounts will be classified as SMA 0. 31 to 60 days, SMA 1. 61 to 90 days, SMA 2. If it crosses 90 days, it will be NPA. Okay, so you need to examine these SMA accounts. If an account has entered into SMA category, then it is a indication that that account might turn NPA. Before it turns NPA, the bank has to take a proper action in order to make it a regular account. Hope that is clear. Next, examine accounts adversely commented by concurrent auditors or internal auditor or RBI inspection team. During the internal audit or during the inspection by RBI, if they have commented on any account, okay, if they have made any adverse comments on any accounts, then auditor, he needs to specifically verify those accounts and examine restructured accounts. Restructured accounts means during the year, if any waive off has been granted to the borrower, or if any reduction in the interest has been given to the borrower, or any extension in the term has been given, in that case you need to verify those accounts which are restructured. And examine quick or early mortality accounts. What are these quick or early mortality accounts? Those accounts which turn into NPA within 12 months of granting the loan is known as quick mortality account. Okay, and completeness and accuracy of interest being charged. You need to verify whether the interest has been properly charged to the loan account or not. Hope that is clear. Next, recoverability of advances. In order to review whether the advances that the bank has given are properly recovered or not, you will verify the periodic statements that are submitted by the borrowers. They will submit periodic stock statements, you need to verify them. And annually they will also submit financial statements, you should also verify those financial statements. And reports on security inspection, review audit reports of borrowers whose credit facilities are beyond the cutoff limit that are set by board of directors by the bank. Okay, you should also review the audit reports of the customers who have taken high amount of loan, okay, who have taken loan amounts exceeding the limits that are set by the bank. you need to review their audit reports also. Okay. Next, classification and provisioning. Basically, the loan accounts in the bank, they will be classified into standard, substandard, doubtful and loss assets. So with respect to this classification, you need to check whether classification has been done automatically through core banking system or not, or any manual intervention is required for classifying the accounts. Basically all the banks, the classification, it is being done automatically by the core banking system itself. You need to just verify whether core banking system is having this capacity or not, and whether classification is appropriate or not, whether such classification that the CBS has made is appropriate as per the circular that has been issued by RBI or not, and proper segregation into secured and unsecured and provisioning. Okay, you need to check whether proper segregation has been made with respect to secured and unsecured loans, and whether proper provisioning has been made based on the classification of the loan account or not. You need to check. Even that provisioning also, the system will calculate automatically. Okay, you have to just feed the percentage of provision that is required. Okay. Next, if an account that was NPA during the previous year continues to be NPA during the current year also, then check whether date of NPA that was shown in the previous year statement is matching with the date of NPA that is shown in the current year statement. Okay. And regularization near balance sheet date. If an account has been regularized near balance sheet date, regularization means an account is actually NPA, but the repayment has been made into the account just before balance sheet date, just nearer to the balance sheet date. In those cases, that account will be not treated as NPA. Okay, it should not be treated as NPA. And you should check whether the repayment was made out of genuine sources of funds. Okay, whether repayment is out of genuine sources of funds. And even after repayment, if there is any inherent weakness in the account, okay, before the balance sheet date the account was regularized, but there is an inherent weakness. Let's say for example, that particular borrower has filed an application for IBC, insolvency bankruptcy code. In that case, even though repayment has been made, there is severe doubt about the business of the borrower. So that account, it will be deemed to be NPA because there is a inherent weakness in the account. And specific case in determining date of NPA, specific care has to be taken for determining the date of NPA, because based on date of NPA, the classification of that particular loan will vary, and based on classification the amount of provision will also vary. So the date of NPA should be determined properly. Next, drawing power calculation. This drawing power calculation, it is mainly useful in case of working capital loan. Now working capital loan, why you will take working capital loan? In order to meet your day to day expenditure, right? Now let's say you have been sanctioned, the sanctioned amount of working capital loan is 1 crore rupees. Let's say 1 crore is the sanctioned amount. Now this working capital loan, it will be sanctioned against security of stock, that is inventory, you can say. What happened? Stock, and also debtors. Against the security of stock and debtors, the working capital loan will be granted. Now the sanctioned amount is 1 crore, but the borrower, he will not be having drawing power of entire 1 crore rupees. His drawing power will be based on his amount of stock and his amount of debtor. Generally once in every 3 months, borrower, he will submit stock statement to the bank. Now in that stock statement, he will furnish the amount of inventory that and the amount of debtors that is available with him. Let's say the as per the stock statement that has been furnished, the total amount of stock and debtors is some 1 point Just a second. Just a second. I'll just close this and open again. Yes. Now, as per the stock statement, let's say the total amount of stock and debtors together is some 1.2 crore. Now, in this 1.2 crore, bank will remove certain margin amount. Let's say margin amount is some 25%. 25% of this 1.2 crore will turn to be, I guess, 20, 25, 32.5. Okay, let it be, let's say 32 crores, 32 lakhs. Okay, 32 lakhs is reduced from 1.2 crores. If we'll reduce 32 lakhs, it will turn to be some 1 crore 90 lakh 88 lakh. Okay, and from this even creditors amount will also be reduced. Let's say net of creditors is 1.2 crores. So from 1.2 crores, if you reduce margin, the total amount that we got is 88 lakhs. Now the sanction, the drawing power of the borrower will be 88 lakhs. This is how the drawing power will be calculated. Okay, first of all, total stock and debtors value will be added. From that, creditors value will be reduced. From that, the margin will be reduced. The available amount would be the drawing power that is available to the borrower. Okay, so in this situation, even though the sanction limit is 1 crore rupees, drawing power as per calculation is 88 lakh only. So for this particular month, borrower can withdraw only 88 lakhs because the amount of stock and amount of debtors that is available with him is lesser as per the stock statement. So as per that, the drawing power is 88 lakhs only. This is how drawing power will be calculated. Now, with respect to this, the auditor needs to check whether this drawing power has been calculated as per the guidelines that have been prescribed by board of directors of the bank. Each bank will be having different guidelines for calculation of drawing power, but more or less it will be same. The percentage amount will differ from bank to bank. And ensure that stock does not cover amount of outstanding creditors. Okay, the creditors amount we have reduced from the stock and debtors value. So creditors should always be reduced from the available stock and debtors value for calculating drawing power. Okay, next, in case of construction business, you should also reduce mobilization advance that has been received by the constructor. Mobilization advance means at the time of constructing the apartments, there will be advance bookings that will happen, right? So for advance bookings, certain token amount will be given by the buyers. So those token amount that has been collected by the constructor, it should be reduced while calculating drawing power. Next, review the stock audit reports. Generally, bank, on behalf of bank also, they will conduct stock audit once in a year. Stock audit will be conducted to verify whether the stock that has been submitted by the borrower as per the stock statement is matching. Okay, whether the physically the stock is present or not, this will be verified in this stock audit by the bank. Next, and this stock statements, they should be submitted once in every 3 months. Generally, for calculating this drawing power, the stock statement, the age of stock statement should not be more than 3 months. See, stock statement for calculation drawing power should not be older than 3 months. At least once in every 3 months, new stock statement should be provided by the borrower for calculating drawing power. And the limits of working capital loan, they should be reviewed at least once in every year. And from the due date, if the limit is not reviewed up to 180 days, then that account will be treated as NPA. Okay, see, limits not reviewed within 180 days from due date, then that account should be treated as NPA. And classification should be borrower wise and not facility wise. What is that? I have told you na, each customer he will be having a unique customer ID. Now on one particular customer ID, he might have taken housing loan, he might have taken working capital loan, he might have taken vehicle loan, he might have taken some other personal loan. Now let's say he is properly repaying housing loan, he is properly repaying working capital loan, but he defaulted vehicle loan and this vehicle loan has become NPA. Now since vehicle loan has become NPA and uh, since the same borrower has borrowed other loans also, even these other loans will also be treated as NPA. Hope that is clear. So classification is to be done based on borrower and not based on facility wise. Next, government guaranteed advances. Now in case of government guaranteed advances, classification of NPA is somewhat different, but income recognition is same. In case of normal loans which are not guaranteed by government, if the loan become NPA, you should not recognize income on that NPA until and unless you realize that income, right? The same will be applicable even if the loan is guaranteed by government. See, government guaranteed loan, income recognition in case of government guaranteed loan, if become NPA, recognize interest only on realization basis. This will not change, this is same, but classification will change. See, asset classification, if the loan is guaranteed by state government, then no difference. Again here it can be classified as NPA, but the change will occur when the loan is guaranteed by central government. If the loan is guaranteed by central government, then the loan should not be treated as NPA until and unless the guarantee has been invoked by the bank and the central government has repudiated that guarantee. See, to be classified as NPA only when central government repudiates the guarantee. Hope that is clear. Agricultural advances. Now in case of agricultural advances, again the classification of NPA is different when compared to other advances. Here in this situation, you need to first of all determine whether the agricultural advance that you have given is whether for short duration crop or long duration crop. Who will tell you which is short duration crop, which is long duration crop? Generally there will be state level committee that will be available in each state. They will decide which will be short duration and which will be long duration. Generally in most of the cases, if the duration of crop is less than or equal to 1 year, then that becomes short duration. If it is more than 1 year, then that becomes long duration. Hope that is clear. Now how this NPA will be classified? In case of long duration crop, if the amount of principal or interest is not paid or it is overdue for more than one crop season, then that loan, that agricultural advance will be treated as NPA. Whereas in case of short duration crop, if it is overdue for more than two crop seasons, then it will be treated as NPA. Hope that is clear. And first of all, there will be RBI circular regarding lending to priority sector. In that lending to priority sector circular, RBI has given list of agricultural crops. Only if the loan has been given for those crops, it will be treated as agricultural advance. If the crop name is not present in that circular and if you have given any loan for that crop which is not there in the circular, then it will not be treated as agricultural loan. Hope that is clear. So ensure these norms are made applicable to all agricultural advances listed in master circular on lending to priority sector. If any agriculture activity or if any crop is not listed in that master circular, if you have given any loan to that particular crop which is not listed on the master circular, then it will not be treated as agricultural advance. Hope that is clear. Next, restructuring of advances. What is restructuring of advance? Decrease in the rate of interest or waiving of some of the interest or increase in the loan tenure, all these they will be coming under restructuring of advances. Whenever there is a restructuring of advance, auditor needs to verify whether the master circular of RBI with respect to restructuring has been followed or not. And restructuring can be done those loans which are classified either as standard, substandard, or doubtful. You cannot restructure a loan which is classified as loss asset. Hope that is clear. And restructuring can be done only from prospective effect. You cannot restructure a loan from retrospective effect. And on restructuring, if a particular asset, if a particular loan is in standard classification and you have restructured that loan, then it will automatically be shifted to substandard classification. Hope that is clear. However, if you have restructured a loan which is already in a substandard or in doubtful position, it will not be again shifted further. It will stay as it is. Only if you have restructured a loan which is in standard position, then it will be shifted to substandard classification. Hope that is clear. Next, sale or purchase of NPA. Now, with respect to selling or purchasing of NPA, you need to examine the policy that has been framed by board of directors. And in order to sell a particular NPA, it should be in your books of accounts for at least a period of 2 years. And these NPAs, they must be sold only on recourse basis. You cannot sell them, sorry, you cannot sell them on recourse basis. You must sell NPS only on without recourse basis. What is this recourse and without recourse? Now, SBI bank, it is having NPS worth 1000 crores. Now it is selling these NPS to some asset reconstruction company. This sale, it should be without recourse. That means if asset reconstruction company fails to recover this 1000 crores from the borrowers, the SBI bank, it will not be having any liability. Okay, it is completely selling this 1000 crores, and it will be headache of asset reconstruction company whether to recover this 1000 crores or not to recover 1000 crores. Okay, asset reconstruction company, it will have to give certain lump sum of amount to SBI, let's say some 950 crores. That's it. Apart from this, SBI will not be having any other obligation, because this sale is without recourse basis. If it is with recourse basis, then if asset reconstruction company fails to recover any of the amount from the borrowers, then it becomes obligation of SBI bank to give amount to asset reconstruction company to the extent of borrowing which was not able to be recovered by asset reconstruction company. So always sale of NPS should be without recourse basis, and it should be on cash basis only. You cannot sell NPS on credit basis. Hope that is clear. And you should not purchase those NPS which you have already sold. Okay, in the past you have sold some NPS, now you again repurchasing those NPS which you sold. That should not be the situation. And once the NPS have been sold, those NPS have to be removed from the books of accounts of the seller. Hope that is clear. Next, non-banking assets acquired in satisfaction of claims. What are these non-banking assets acquired in satisfaction of claims? Whenever bank is giving loan, it will give loan only based on security. Let's say some land has been offered as security and the borrower failed to repay the amount, so the land, it will be taken over by the bank. So this land, it becomes non-banking assets acquired in satisfaction of claims. Now these non-banking assets, they must be held by the bank with an intention to dispose of them in the near future. Okay, and verify documentary evidence. Auditor need to verify whether the ownership has been properly transferred into name of the bank or not. Check the ownership is vested with the bank. And compliance with holding period of such assets. Generally, the bank, it should not hold those assets for a period exceeding 7 years. Within 7 years, it has to sell off those assets until and unless it decided to use those assets for the banking business. Hope that is clear. And these assets, they should be recognized lower of net book value of the advance or net realizable value of the asset, NRV of the asset or NRV of the loan, whichever is lower. At that value you need to recognize this asset in your books of accounts. Hope that is clear. Next, capital risk adequacy ratio. Banks, they need to maintain a minimum capital risk adequacy ratio of 9%. Next, stress testing. What is stress testing? In this stress testing, banks ability to continue their business if any uncertain economic event happens will be tested. Okay, whether bank is in a stable position to continue its business even if there is any downturn in the economy or not, this will be tested. Okay, the capacity of the bank will be tested in this stress testing. Next, current and savings account. With respect to this current and savings account, auditor, he needs to first of all verify whether while opening these current and savings account, all the KYC norms, all the KYC documents have been collected or not, and check interest calculations. In case of savings account, whether interest calculations have been done properly or not. And if there are no transactions in the account for a period of, for a continuous period of 2 years, then that account must be classified as inoperative account. And significant balances of accounts. Now, once the account has been classified as inoperative account, if any transaction takes place in that account, it will be again reclassified as operative account. Now, if there is any significant transaction that has taken place in an account that has been recently made to operating position, auditor needs to be careful with that account whether employees have committed any fraud in that account. Okay, there might be some 1 crore rupees in a particular saving account, and this saving account, it has become inoperative. That means for 2 years there are no transactions in this account. So what employees of the bank have done, they have made this account operative by making some deposit of some 500 rupees or something like that, and after making it operative, they have withdrawn this entire 1 crore rupees fraudulently. So just after the account has become operative, a huge transaction has taken place. If at all this happens, auditor needs to check whether there is any fraudulent intention behind that transaction. Hope that is clear. Next, Basel 3 framework. This Basel 3 framework, it aims at making the banks more stable to face economic downturns. See, improve banking sector's ability to absorb shocks from financial and economic stress. And this Basel 3 framework will also provide guidelines for improving risk management and governance practices in the bank. And it will also provide guidelines for strengthening banks transparency and disclosure standards. Basel 3 framework, it will provide guidelines with respect to three aspects. What are they? First of all, improving the bank's ability to face uncertain events. Next, improving banks risk management process. And finally, strengthening banks disclosure aspects. Okay, disclosure and transparency related aspects related to this, the guidance will be given in Basel 3 framework. Next, bills payable. Basically here, bills payable means the demand drafts that the banks will issue, telegraphic transfers that the banks will make, and traveler checks that the banks will issue. All these, they will be coming under bills payable. Now, with respect to these bills payable, auditor needs to check that standard formats are being followed by the bank, and unused forms, they are in the proper custody of responsible officer. And the private codes with respect to these telegraphic transfers, they must be known only to the responsible officer, they should not be made public. And signature on the demand draft has to be cross checked by the specimen signature book. And once TT or DD is issued, the communication has to be made to the respective bank on whom this, or the respective branch on whom this TT or DD is drawn. And once the respective branch has made the payment of that demand draft, the communication has to be again sent to the branch which has actually issued this DD or TT. Okay, there should be communication between these two branches. At the time of issuing the DD, the issuing bank should communicate. At the time of payment, the payment bank should communicate to the issuing bank. Okay. Next, contingent liabilities. There are certain contingent liabilities that the bank will be having. Firstly, claims against bank that the bank has not acknowledged as due. Okay, third parties, they are claiming that bank has to give some amount to them, but bank is not accepting this amount as debt. This becomes a contingent liability. There might be some case, okay, that might be pending in the court in order to decide whether bank has to pay the amount or bank has not to pay the amount. So this liability will be decided based on the outcome of the court. So this becomes a contingent liability. Next, liability for partly paid investments. Let's say, for example, bank has subscribed to shares of a particular company, and that particular company, it has made first call of, let's say, some 5 rupees. Still second call of 5 rupees is pending. Till the time that company makes second call, this liability will be treated as contingent liability. Okay, bank will have to pay that amount only when that company makes second call, and until and unless that company makes a second call, this amount, it will be contingent liability for the bank. Liability for outstanding forward exchange and derivative contracts. Forward exchange contracts, their rate, they will be decided based on future exchange rate. If at all there is any increase in the rate, then bank, it has to incur some amount out of its pocket. So it becomes a contingent liability on part of bank. Next, guarantees given on behalf of constituents. If the bank has given any guarantees, even that becomes a contingent liability for the bank, and any other type of contingent liabilities. Next, management representations to auditor regarding contingent liabilities. Management has to make certain representation that all the off balance sheet items have been properly accounted in the books of accounts. What are these off balance sheet items? Generally, most of the contingent liabilities, they will be off balance sheet items only. Off balance sheet means they will not be recognized in books of accounts. If they are not recognized in books of accounts, auditor, he cannot find out that off balance sheet items are existing. So management has to give a representation to the auditor that we have recognized off balance sheet items in the books of accounts, and all the relevant documentation with respect to off balance sheet items must be maintained. Best example of off balance sheet item is guarantee that has been given by a bank. Now with respect to the guarantee, the relevant documents with respect to whom the guarantee has been given, and why the guarantee has been given, all these necessary information has to be maintained with respect to off balance sheet items. Next, management has to give representation to the auditor that all the contingent liabilities have been properly disclosed in the books of accounts. And also management needs to give a representation that management have not disclosed those contingent liabilities which have crystallized as liability. Okay, if a contingent liability has turned to liability, we haven't disclosed it as a contingent liability. Even this representation has to be made. Next, if a contingent liability turns into liability, what effect it will have on the bank? This effect of turning contingent liability into liability should also be disclosed as per accounting standards. And if management has not disclosed any of the contingent liability because of the reason that the probability of that contingent liability turning into liability is very remote, then in that situation management has to disclose the reason. Okay, management has to specify the justification behind such a decision taken by management. Okay. Next, audit procedures regarding contingent liabilities. First of all, auditor needs to ensure that non-fund facilities are given only to regular customers of the bank. Non-fund facilities like guarantees, letter of credits, these should be given only to the regular customers of the bank. If in case these have been given to any other person, then auditor needs to check the credit worthiness of such other person. Hope that is clear. Next, there should be adequate internal controls with respect to issuance of these non-fund facilities, these contingent liabilities, and also there should be proper accounting system for these contingent liabilities. And overseas supplier is paid based on shipping document. This point it will arise in case of letter of credit. Generally, Mr. A, who is in India, has imported certain material from Mr. B, who is in USA. Now, let's say the value of this material is some 1 crore rupees. Now, this 1 crore rupees, Mr. A, he cannot directly pay to Mr. B until and unless goods have been received by Mr. A. In the same way, Mr. B cannot send the goods until and unless this 1 crore rupees has been given by Mr. A, because there will be some trust issues. So, in order to avoid these trust issues, there is concept of letter of credit. Under this letter of credit, what will happen is Mr. A, he will approach his banker, let's say SBI banker, and he will explain the situation to banker, and he will ask the banker, just a second. Yeah, and he will ask the banker to issue letter of credit for rupees 1 crore rupees in the name of Mr. B's bank. Okay, let's say Mr. B is having account with Bank of America. Now, here in India, Mr. A, he will deposit 1 crore rupees with SBI, and SBI will give letter of credit to Bank of America in the name of Mr. B, and there will be certain terms and conditions for this letter of credit. Here, the SBI has not transferred any fund to Bank of America, just a guarantee type. Okay, a letter of credit has been issued to Bank of America. Now, the terms and conditions of this letter of credit will be like SBI will pay the amount to Bank of America only after Mr. B has sent goods to Mr. A. That is based on shipping documents, amount will be paid. Okay, this is one of the condition of letter of credit. Okay, so auditor, he needs to the basic internal control that should be present with respect to this is amount has to be paid only after shipping documents has been submitted. Okay, next, test completeness of recorded obligations, whether all the contingent liabilities that have been recorded by management are complete or not, or any of the contingent liability is missing. Hope that is clear. Next, claims against bank not acknowledged as debt. Some third party, he is saying that bank has to pay certain amount to it. Bank is liable to pay certain amount to them, but bank is not acknowledging it as debt. Now, with respect to this, auditor needs to examine the relevant evidence. Okay, based on the evidence, auditor needs to examine whether bank will be liable or bank will not be liable. A preliminary examination will be done by the auditor. However, the final judgment, it will be decided by the court. Okay, if there is a dispute, then obviously a case will be filed in the court, and court will decide whether bank is liable or not. Next, review meeting of minutes of the meeting. By reviewing minutes of the meeting, auditor can find out any new contingent liabilities that are existing against the bank. Okay, next, ascertain status of outstanding claims from management. You need to ascertain from the management these amounts, they are in dispute now. What is their status? Whether the dispute has been resolved or still the dispute is going on. What is chance of you winning the case? All these matters you need to inquire with the management, and also you need to go through the subsequent events. As on 31st March, the dispute might be existing. It might be contingent liability, but after 31st March, it might have been cleared. So, by checking the subsequent events, you can decide whether that contingent liability has crystallized into liability or that contingent liability has not crystallized into liability. That you can check by verifying subsequent events. Next, guarantees given on behalf of constituents, means on behalf of customers. You need to first of all check adequate internal controls are there over issuance of guarantees, and unissued guarantee forms, they should be kept in the custody of proper officer, and whenever you have issued the guarantee, it will be entered into the register stating that guarantee for this much amount has been given to so and so person on this date. Now once such guarantee expires, it should be striken off from the register. Okay, it should be marked off, and ensure all guarantees are disclosed. Okay, and verify guarantees with letter of guarantee that has been issued by bank, and also if at all any counter guarantee has been issued by customer, you should also verify that. Counter guarantee means in some cases what will happen is, let's say A Limited has approached SBI Bank to issue guarantee, but A Limited is not having any relationship with SBI Bank, but A Limited's holding company might be customer of SBI Bank. Now in this situation, SBI Bank might keep a condition that, okay, A Limited, I will give you the guarantee, but subject to the condition that your holding company is there. Now it should give me a counter guarantee. That means if you fail to fulfill that, your holding company should fulfill it. So that is known as counter guarantee. If at all any such counter guarantees have been given, you need to verify that. Next, verify securities held as margin. For giving guarantee, if any security has been taken, you need to verify that. And if claims have arose, whether provision is required as per accounting standards. If provision is required, auditor needs to verify whether provision has been made or not. Next, bills for collection. This concept we have already discussed. Next, audit report of bank shall contain, see, the audit report of bank, it needs to state, the auditor, he needs to state that balance sheet, whether it is showing true and fair view or not. Profit and loss statement, whether it is showing true and fair view or not. And whether information and explanation that has been asked by the auditor has been submitted by the bank or not. And whether all the transactions that the bank has entered are within the powers of that bank or not. And returns that have been received from the branches are adequate for the purposes of the auditor or not. And any other matter which the auditor needs or which the auditor thinks to be brought to the notice of central government, he needs to disclose them, he needs to report them in the audit report. Okay, next, long form audit report, LFAR. See, in case of banks, normal audit report will be given, and also LFAR will also be given. Okay, long form audit report will also be given. Generally, in case of companies, we'll just give the normal audit report. Now, along with that audit report on financial statements, here in case of banks, LFAR, long form audit report, will also be given. In this long form audit report, there will be certain points that needs to be verified by auditor and needs to be reported in this long form audit report. Now this long form audit report, it will be issued both by statutory branch auditor as well as by statutory central auditor. Branch auditor at branch level and statutory central auditor at entire bank level. Now this statutory branch auditor, his LFAR, it will be sent to statutory central auditor. Now the statutory central auditor, he will combine all these LFARs and will prepare a single LFAR for the entire bank. See, to be given by SBA as well as SCA. SBA gives LFAR to statutory central auditor and he consolidates at the bank level. Now the central statutory auditor, after he has prepared his LFAR, it will be submitted to management of the bank. Now place this LFAR before audit committee board with action taken report and submit LFAR to audit report to RBI within 60 days of submission by auditors. Okay. Once auditors have submitted this LFAR to management, management has to further submit this LFAR to RBI within 60 days from the date on which auditor has submitted it to management. Hope that is clear. Next, reports and certificates. Now in case of bank, apart from audit report, there will be various certificates that the auditor needs to issue. First of all, auditor needs to issue report on internal financial control over financial reporting. Then auditor will issue long form audit report. Then auditor will have to issue report on SLR requirements, statutory liquidity ratio, whether the bank is properly maintaining the statutory liquidity ratio as per the RBI mandate. On this, auditor needs to certify. However, this certificate, it will be given at central, okay, by statutory central auditor, not by statutory branch auditor, because SLR, it will be maintained at entire bank level. So report on SLR requirements. Next, report on treasury operations. Treasury operations means cash management. Auditor, he needs to certify whether cash has been properly managed or not. Next, certificate on reconciliation of securities. Here, reconciliation of securities means share capital. During the year, what is movement in the share capital, how many shares have been sold, how many shares have been purchased, how many shares have been newly issued. Regarding this, a reconciliation statement will be made and it will be certified by the auditor. Next, asset liability management, ALM will be calling it. Now in case of bank, major assets will be loans given and investments made. Major liability will be deposits accepted. Now the bank, it needs to properly manage its deposits and the loans and the investments that it has been given. The rate of interest that the bank gives on deposit should always be lower than the income that is generating from these assets. And also it should not give away all the deposits that it has taken in the form of loans and investments. It needs to keep certain amount with itself. So this entire process is known as asset liability management. Whether the bank is properly managing its assets and liability or not, it needs to be certified by the auditor. Next, certificate on interest subsidies and interest subvention. Generally, for certain types of loans like some education loans, some agricultural loans, there will be interest subvention. That means a discount in interest. Government will reimburse the bank for this discount that the bank has given to the customer. So this we will be calling as interest subvention. Now this interest subvention has to be properly audited by the auditor, and auditor needs to certify that the amount that the bank has shown as interest subvention is correct, because there might be a chance that bank might increase this interest subvention amount in order to get amount from the government. Let's say for example, bank has given interest discount of only some 10 crore rupees during the year, but since this amount will be reimbursed to the bank by the state government or the central government, there is a chance that bank might show this amount as 100 crore rupees. Okay, this type of fraud can happen at the bank level. So in order to avoid this, auditor needs to check whether this interest subvention amount has been properly calculated by the bank or not. Next, certificate on corporate governance for listed companies. In case of listed companies, as per the LODR regulations, certificate on corporate governance is required. Next, authentication of CRAR. Okay, capital risk adequacy ratio, whether it has been properly calculated or not, and whether minimum 9% of CRAR has been maintained or not, and other ratios that are reported in the notes to the accounts are properly calculated or not. With respect to this, auditor needs to certify. Next, report on Ghosh and Gilani committee recommendations. Basically, this Ghosh and Gilani committee has made certain recommendations that needs to be implemented in the bank in order to avoid fraudulent activities. So whether these recommendations have been implemented at the bank or not, regarding this, a report has to be given by the auditor. We will be calling it as Ghosh and Gilani report. It will be dealing with recommendation with respect to avoiding fraudulent activities in the bank. Next, scope of concurrent audit. Basically, in case of concurrent audit, you will be auditing the transactions as and when they occur. Okay, each day you will audit the transactions that has occurred during the year, and this concurrent audit report, it will be given on a monthly basis. Here the scope of concurrent audit will include cash, the advances that the bank has given, the deposits that the bank has taken, and if the bank is having any foreign exchange transaction, even that will be included in the concurrent audit scope, and investments that the bank has made, housekeeping activities and other items. All these aspects, they will be included in the scope of concurrent audit. And with respect to foreign exchange, we have already discussed earlier the same points, they will be applicable. Appointment of concurrent auditors. Now, whether to appoint a individual external chartered accountant as a concurrent auditor or appoint the own staff of the bank as concurrent auditors, it is left to the discretion of the bank. Okay, whether to maintain own staff of concurrent auditors or to hire the concurrent auditors from external basis, it has to be decided by the bank itself. Next, tenure of the concurrent auditors, it will be decided by audit committee board. However, the tenure, it should not exceed 5 years, and also the same concurrent auditor, he should not audit the same branch for a period exceeding 3 years. Hope that is clear. For same bank, the concurrent auditor should not work for more than 5 years, and for same branch within the bank, he should not audit for more than 3 years. And terms of appointment and remuneration will be fixed by audit committee board. Next, reporting. Now, with respect to reporting, if there are any serious irregularities, auditor, he needs to report to the head office immediately. Okay, and quarterly and annual zone-wise reports, they will be they will be reported to audit committee board. Okay, quarterly findings and annual finding report, it will be sent to audit committee board. And report on fraudulent transaction. If at all there are any fraudulent transactions, you need to report to 3 persons. First of all, to the bank manager, branch manager, you will report this fraud, and there will be chief vigilance officer. You should also report this fraudulent activity to chief vigilance officer, and finally you should also report to inspection and audit department. Hope that is clear. To these people, you will report any fraudulent transaction that has taken place. By this, we have completed revision of bank audit. And if you want to download this chart, I will be providing the link in the description. From there you can download it. And if you want to purchase our classes, you can visit our website lecturepedia.in and you can place your order. And by this, I will be winding up this class as of now. Take care. Bye bye. See you.